Hello, good day. How are you? I hope you are fine. Is the capital market efficient? Do prices adjust quickly and correctly to new information? The question of whether capital markets are efficient is one of the most controversial areas in investment research. Some of the most interesting and important academic research during the past 40 years has analyzed whether the capital markets are efficient. This extensive research is important because its results have significant real-world implications for investors and portfolio managers. The objective of this video is to describe the concept of market efficiency, the characteristic of an efficient market, and the challenges that investors face when markets are efficient. We shall also discuss the competing ideas and present some evidence on both sides, and then examine the implications for financial managers and investors. At the end of this learning session, students should have achieved three learning objectives. First, an understanding of the importance of the efficient market hypothesis to corporate finance and investment. Second, an ability to explain the difference between the various forms of market efficiency. And third, an appreciation of the empirical research that has been undertaken on market efficiency. Stay tuned and let's learn together. In 1953, Maurice Kendall, a British statistician, found that the prices of stocks and commodities seem to follow a random walk. What is random walk? A random walk is an irregular pattern of numbers. Changes in stock prices occur randomly. This means stock price movements do not follow any pattern or trend. Tomorrow's price change is unrelated to today's, yesterday's, or to that of any other day. Successive changes in value are independent. Why does random walk occur? Random walk is actually a natural consequence of a financial market operating with a high degree of efficiency. What are the impacts of random walk? With random walk, past price action cannot be used to predict future price movements. The random walk hypothesis asserts that price movements are unpredictable. Therefore, security analysts will not help to predict future market behavior. Let's learn more definitions about price pattern and expected return. What is a fair game? What are the key differences between martingale and submartingale? A fair game is a situation in which the expected return on an asset equals its actual return. Fair game can exist across a large number of samples. In a fair game, the expectations are unbiased. Both martingale and submartingale is a form of fair game. The key difference is martingale assumes tomorrow's price is expected to be the same as today's, so that the expected return is zero. Submartingale assumes that tomorrow's price is expected to be greater than today's, so that the expected returns are positive. How would these concepts related to random walk? Well, random walks are stronger than martingales or fair games, because random walk requires all moments of the distribution to be the same with or without any information structure. A capital market is informationally efficient if all prices instantaneously and fully reflect all relevant available information. This means security prices adjust rapidly to the arrival of new information, and therefore the current prices of securities fully reflect all available information about the security. A key implication of market efficiency is that it will be hard to make money in the financial markets. This is because securities are fairly priced and that their expected returns equal their required returns. When stocks are fully and fairly priced, investors need not waste their time trying to find mispriced, undervalued, or overvalued securities. There is no reason to believe that the current price is too low or too high. Only new information will cause prices to change. In efficient market hypothesis, we are referring to informational efficiency and not allocative efficiency nor operational efficiency. Allocative efficiency means optimal allocation of savings to productive investment. This means the marginal rate of return adjusted for risk for all borrowers and savers are equal. Operational efficiency means minimizing transaction costs. The efficient market hypothesis has transformed the way finance is viewed and conducted. In year 2013, Eugene Fama was awarded the Nobel Prize for Economics for his contributions to the development of the efficient market hypothesis and the empirical analysis of asset prices. In the next few slides, we are going to ask a few important questions. First, why are we interested in capital market efficiency? Capital market efficiency is implicit in many of the models involved in financial decision making. If markets are not informationally efficient, then the market mechanism will not work. If markets are not efficient, would you invest in the market? Well, investors will think that equity prices are not a good signal of the value of a company. Some investors will withdraw from equities. Thus, equity capital will dry up. When there are less capital available, firms will have less funding for investment. Ultimately, the effect will spread to the real productivity. GDP, income, employment would all fall. Not all market participants are believers in the efficient market hypothesis. Why should capital markets be efficient? An important premise of an efficient market requires that a large number of profit-maximizing participants analyze and value securities, each independently of the others. The buy and sell decision of these investors lead to security prices adjust rapidly to reflect the effect of new information. A second important assumption is that new information regarding securities comes to the market in a random fashion, and the timing of one announcement is generally independent of others. Capital markets are efficient when all investors are rational. When new information is released in the marketplace, all investors will adjust their estimate of share prices in a rational way. Perhaps at certain times, most investors are swept away by excessive optimism and at other times are caught in extreme pessimism. However, the independent deviations from rationality of many different investors will offset irrationalities and produce efficiency. Lastly, arbitrage activity in the marketplace will lead to market efficiency. The arbitrage of professionals will dominate the speculation of amateurs, and markets will still be efficient. How should stocks be priced in an efficient market? Well, Stock prices should instantaneously adjust and fully reflect new information. Prices should approximately follow a random walk with a positive drift. In the formula, mu stands for expected return and E is a random error term. This suggests that price changes will be simply the expected return plus a random error term. Therefore, price changes and returns should be unforecastable around their mean in an efficient market. How would market respond to new information? From the figure, there are three possible scenarios. The solid horizontal line represents the path taken by the security in an efficient market. In this case, the price instantaneously adjusts to and fully reflects new information. There is no tendency for subsequent increases and decreases. Delay reaction and overreaction show the path that share price might take in an inefficient market. The delay reaction line shows that the price adjusts slowly to the new information. A few days elapse before the price completely reflects the new information. The overreaction line shows that the price over-adjusts to the new information. There is a bubble in the price sequence, and subsequently price correction back to the true price. Let me ask you a question. Which of the three scenarios can generate trading profits for investors? Well, if the share price takes several days to adjust, trading profits would be available to investors who time their purchases and sales suitably. Therefore, investors can generate profits in an inefficient market, be it overreaction or delayed reaction. Let's look into an example. Philip Green announces his intention to take over M&S in a press release on 26 May, after the close of the market. In an efficient market, the share price will adjust quickly to this new information. Investors should not be able to buy the stock on 27 May and make a profit. If the market is efficient, the share price of M&S on the next morning will already reflect the information contained in the press release. Philip Green announces he has abandoned his bid in the evening of 14 July. The share price declined immediately when the market opens the next morning on 15 July. Farmer define three nested forms of market informational efficiency. First, in weak form efficiency, current prices reflect all information embodied in past prices. Therefore, it is impossible to predict future direction of price movements by analyzing past prices. Second, according to semi-strong form efficiency, current prices fully reflect all publicly available information, including that on fundamentals. For example, share price has fully reflected public information about the state of the economy, the information contained in company reports, as well as analyst recommendations and product reviews. This means that investors cannot consistently earn abnormally high returns using publicly available information. Third, the strong form efficiency states that the stock price rapidly adjusts to any information, including insider information, even though it is not available to every investor. As a result, no investor can earn excess returns using any information, whether publicly available or private. What types of information are captured by asset prices? The strong form efficiency includes information in semi-strong form efficiency, while the semi-strong form efficiency has reflected information in the weak form efficiency. From the figure, take note that the line of causality runs from strong form to semi-strong form and then to weak form, but causality does not run the other way. Let me ask you two questions. Which level of efficiency captures all information? Which level is the most efficient and reflects the most complete information set? I'm sure you know the answer. The answer is strong form efficiency. What are the implications for investors if the stock market is efficient? In general, if the stock market is efficient, paying for investment research will not produce above average returns. Technical analysis or trading rules are a waste of time if the market is weak form efficient. Fundamental analysis is a waste of time if the market is semi-strong form efficient. Any attempts to seek out inside information in order to beat the market is a waste of time when the market is strong form efficient. To conclude, there are no bargains or underpriced shares to be found on the stock market. Because information is reflected in prices immediately, investors should only expect to obtain a normal rate of return. Here comes another important question. If equity markets are efficient, why do equity analysts exist? If stock markets are efficient, surely all equity research activity is fruitless. Bear in mind that collecting information is not costless. Research expenses are involved. Jensen 1982 has a good definition about market efficiency. Hopefully this will help us to answer the question better. According to Jensen, if a market is efficient with respect to an information set, data, it is impossible to systematically make excess profits by trading on the basis of data. Therefore, excess profits refer to profits above those required to compensate for information and transaction costs. So, it might be possible to predict the market, and still the market can be efficient, but prediction will be hard work and costly. Let's have a quick quiz to test your understanding so far. Which of the following suggests that the market is inefficient? What is your answer? The answer is number 1, 2, 3, 4, and 5. Why is that so? In the case of number 1, stock returns have a predictable pattern and therefore is inefficient. For number 2, 3, 5, when abnormal return can be made from the stock market is inefficient. For number 4, an efficient market will have its prices immediately adjust to and reflect new information. Therefore, bubbles that form slowly is a form of inefficiency. Finally, we have come to the end of this video. I hope you have learned some knowledge from this video. If you like this video, please click like, share or subscribe to my YouTube channel. Thank you. See you and goodbye.